Welcome back to the Talkin Tax podcast, episode 3, brought to you by your host Omar Aswat, Chartered Tax Advisor, regulated by the Chartered Institute of Taxation, and founder and owner of specialist tax advisory firm ASWATAX, where we provide a range of tax advisory services, regularly working on cases such as inheritance tax planning, capital gains tax planning, corporate restructuring, trusts, family investment companies, tax stages throughout the business life cycle, tax inquiries and investigations, and lots more. In this episode, we will be discussing an area of tax which is very dear to my heart and very close to my heart, in the sense that, I know a lot of you will be finding me weird at this moment in time, because, tax is one of them subjects. However, the reason I like this area is because I would say I'm very well versed in this particular area. Why? Because when the new rules did come out a few years ago, when the new rules were introduced, I spent a lot of time, to be honest, reading through the legislation, reading through the guidances, reading different articles, really mastering and becoming an expert at these particular rules. And at that time, I worked at a firm called Talkin Tax. And because these rules were new at that time, we used to get a lot of questions around it. So I thought, let me spend a good few days and let me master this area of UK taxation. And the episode and the topic is the 60-day reporting for capital gains tax purposes. So in certain instances, capital gains tax has to be reported and paid for within 60 days. Now, previously it was 30 days, but now recently they extended it, or they doubled it to 60 days, which makes sense because 30 days to make a payment of a significant tax liability when you're asset rich and not cash rich. I can quickly see problems happening from that angle, but also the fact that we live in such a fast-paced environment where there's no blessings in our time, and 30 days goes by like that. I'm recording this episode 12th of May 2024, and I have no idea where the last 4 months have gone. So if we start with an overview, and then we will go through different scenarios, different angles that can be discussed in relation to this particular matter, with a few example case studies towards the end. So bear with me. I don't want to make this episode too long. However, I do want to, give you as much information as possible, so that this can be, for you to, if you were to listen to this, you can also call yourself, well versed in this area. By way of an overview, so the default position is that if you normally complete a tax return, you would report your capital gains tax or your CGT. Anything related to CGT would be reported on the self-assessment tax return using the capital gains tax pages. If I'm not mistaken, let me just double check. I think it's the SA10. No, it's the SA10. SA capital gains tax. This is something I generally know. SA108. Okay, just I always get confused. So SA107 is trust, SA106 is SA105, I think, is foreign, SA106 is property, SA107 is trust, SA108 is capital gains, and SA109 is residency, remittance, and domicile status. So SA108. So by default, you'd report your capital gains tax implications or issues, anything related to capital gains tax on the SA 108 up until these new rules were introduced. We'll come to that. The SA 108 pages would be used if either your gains for the year are more than the annual exempt amount. So before deducting any losses, your gains for the year are more than the annual exempt amount, which is, £3,000 for the current tax year, which is the 24-25 tax year. Last year, 23-24, which would still be relevant, was £6,000, and prior to that it was 12,300. So the annual exempt amount was 12,300 for many years, and then last year reduced down to 6,000, and in the 24-25 tax year it is now at an all-time low of £3,000, which I think is very if strict is the right word, as in it's subduing a lot of taxpayers. Generally, the current landscape, the political landscape, especially if the Labour Party were to come into power, it's not looking good for property landlords and business owners, broadly speaking, or high net worth individuals. Now, I know they talk about a fair tax system and the rest of it. However, there has to be some sort of balance, in the sense that it is the business owners that create jobs ultimately and take on the risk. It is for the sake of the country's economy that we incentivize investment into the UK, and you have hubs set up in the UK, not forcing people out, which is the current climate, unfortunately. You may differ with me, so feel free to leave your comments, but from the conversations that I have and the type of clients that I deal with, they're not too happy, broadly speaking. So you need to use the capital gains tax SA 108 pages if your gains before deducting any losses for the year are more than the annual exempt amount, as mentioned, of £3,000, or in any instance your sales proceeds are more than £50,000. So even if your gains are less than the annual exempt amount, you must report. However, for example, if there's no capital gains tax to pay, in the instance, as an example, if you're disposing of your main home, your principal private residence, you could call it, your main residence, and PPR relief applies on the full amount of the gain, then in that instance, for example, you don't have to report anything. If there's a CGT liability, then again, this is payable via self-assessment. So reported via self-assessment, also payable by self-assessment. And how does that work? It is the 31st January deadline following the end of the tax year. However, and this is where we get into the topic of the episode, you have the UK land and property 60-day reporting. So for UK land and property, this can be divided into two sections. One is UK residents and the other is non-UK residents. So I'll start with UK residents. So the 60-day reporting only applies to UK residents if they are disposing of UK residential property. Keep that in mind. So a lot of times I get asked the question, if a UK resident is disposing of commercial property, for example, well, then the 60-day reporting requirements or the payment does not apply. So therefore, the key point there is that if it is UK residents, then they must report within 60 days, but only the disposal of UK residential property. Unless, of course, there is no tax to pay. If there is tax to pay, then the gain should be paid also within 60 days. I'll explain later on in the episode exactly how you go about, so the actual practical mechanics in terms of registering an account for the 60-day reporting service and the rest of it. And I just keep in mind that you are required to report this disposal or the UK residential property disposal within 60 days, even if you are registered under self-assessment. So even if you intend to file a self-assessment tax return for that year at some point, then you still are required to report within 60 days and pay within 60 days. with one exception. So there is one exception, which is that where the self-assessment return is filed before the 60-day deadline were to arrive, or when the self-assessment return deadline falls before the 60-day deadline. So either, so you actually filed before the reporting deadline, or the 31st Jan deadline falls before the 60-day deadline, then you can just do this directly you can just do this directly on the self-assessment tax return. So remember, that was disposals by UK residents. My question to you is, if this was a live webinar and there was we could ask the question, we could have the poll, then we would ask this question. For disposals by UK residents, what is reported within 60 days? It is the UK residents disposing of UK residential property. Non-residents, however, a non-resident that disposes of any UK land and property. This is the key difference. Any UK land and property, not just residential property. Non-residents must report within 60 days. So any UK land and property, non-residents must report within 60 days. If there is any tax to pay, then it is also due within 60 days. I hope that makes sense. So just to recap what we're discussing. If you are a UK resident, and you're disposing of UK residential property, then do you need to report within 60 days? Yes, if there is tax to pay, and the deadline for paying tax is also 60 days. However, if you are disposing anything other than UK residential property, then no, you don't need to report within 60 days, and the deadline for paying the tax is 31st Jan following the end of the tax year as normal. If you're a non-UK resident, UK land and property, report within 60 days, pay within 60 days, and that's the key difference, which is that non-residents need to report and pay for any UK land and property. So that includes commercial property, land, and residential property, broadly speaking. Capital gains tax for non-residents may not apply to the whole gain. So you just need to, that angle needs to be considered as well, in terms of, for example, rebasing, temporary non-residence rules, and the rest of it. I don't want to go too much into that, because that is more around residency, domicile, and foreign aspects of UK taxation. In terms of the practical mechanics on how to create the 60-day report, you need to go on to, you can just type in on Google, capital gains tax on UK property account, something like that, capital gains tax CGT on UK property account, and you need to create a government gateway ID. And generally speaking, you create the government gateway ID, you have a password, you need to authenticate as well. So usually you get a text message to a mobile number, you get a call to a mobile number, or there's the Authenticator app, which I use when I'm offshore. There's the Google Authenticator app, which works quite well. So you need to sign in. Just keep in mind that if you receive an error message when you are trying to create the CGT on UK property account, HMRC generally advise that you should review and update your address in your personal tax account. So this is, you're already registered for self-assessment. You need to update, or first review and then perhaps update your address in your personal tax account. If you live in the UK, check that the postcode field is correctly populated. And if you live outside the UK, check that the country field is correctly populated. So this is from experience, whereby these items need to be looked after. Broadly speaking, we are we are living in a digital world, but there's always a paper form that you can fill out, and you'd need to contact HMRC for that. However, I wouldn't recommend anyone to do that. So yeah, broadly speaking, it's just about then going through the steps on the government gateway account, and broadly speaking, that's just a lot of them are very straightforward questions. However, there are some technical or tax technical questions, and that's where we can get involved. And as in we fill out these forms, such forms, and we advise on such transactions for our clients as well. What happens if you miss the 60-day reporting deadline? If you don't file the report in time, HMRC advised that you should still file the report late, so better late than never, before reporting the disposal on your self-assessment tax return. There's many reasons for this, and one is that there's no discrepancies. Most likely, sorry, I don't want to say most likely. I don't want to say most likely because HMRC are fairly lenient in this angle, but you may be charged late submission penalties. So depending on how late the 60-day report is, you may be charged late submission penalties. But broadly speaking, these won't be the daily penalties. How it works for self-assessment, HMRC are broadly speaking lenient when it comes to such matters. How do we calculate capital gains tax when preparing the 60-day report? Now, broadly speaking, you would want to speak to a professional advisor, your accountant. Ourselves, we can do this for you, but I'll give a quick breakdown in terms of how it is calculated. You have your sales proceeds, so that's the amount of consideration received, the amount of cash received, less incidental costs of sale, which gives you your so that's basically gross sale proceeds less incidental costs of sale, which gives you net proceeds. And then from there you deduct your base cost, which is your purchase price, any enhancement expenditure, any incidental costs on purchase. That gives you your capital gain, and then you take off any losses, you take off the annual exempt amount, which gives you your chargeable gain. And then your chargeable gain is at either 10%, 18%, 20%, 24%, or 28%. 5 different rates of tax. For UK residents, it'll either be 18, 24, 28. Why? Because these are the rates for residential property. For land and commercial property, UK land and commercial property, we'd probably be looking at 10% or 20%. If you don't have, if you do have any issues, for example, with any of the figures, any of the percentages, make your best estimate, but get the return in. So you can make a reasonable estimate. And another area where you need to make a reasonable estimate is when you're looking at your other taxable income, because how do we know if it's at 18% or 28%, for example, or 10 or 20%, 24%, to complicate things further, because the tax year has not complete, for example. So you don't know whether you're going to sit in the basic rate band or in the high rate band, or what proportion of the gain will be taxed at the basic rate and what proportion will be taxed at higher rate. So that you can make a reasonable estimate, and provided that the estimate is reasonable, as long as you can. When we use it in tax, a lot of the times we need to make estimates, and we use the term reasonable. And what I mean by reasonable, or what one should understand by the term reasonable, is justifiable. If someone were to ask you questions, how did you come to this figure, you can justify it. If you come out with some complete lick of the finger random figure, then it's unacceptable, right? So that needs to be taken into account. Sorry, I've got this plate of food that my wife brought right in front of me. She did say it's quite hot, so let it cool down a bit, but it's just staring at me now. Hence why I just had to have a quick nibble. Once you do know your taxable income for the year, so your actual, you should recalculate the capital gains tax due and report the disposal on the self-assessment tax return. So, or you may submit an amended 60-day return, but broadly speaking, you must let HMRC know. And no late payment interest should apply if the estimate turns out to be too low, and you pay any difference by the normal self-assessment due date. You can get potential late payment penalties if you pay late, but these are calculated, broadly speaking, in reference to the normal self-assessment filing dates. So these would be payable 30 days from 31st Jan following the end of the tax year. So a lot of these, when it comes to penalties and the rest of it, I know it's an area in and of itself, but I'm assuming that but please reach out if you want any clarification. If the estimated tax, as we said, the taxable income and the rest of it needs to be estimated at times, if it turns out to be too high, then you get your repayment, and you get some interest paid on the repayment as well. So that's that. There is a particular area that I wanted to discuss, which I've seen quite a lot in practice, which is if you make multiple disposals in a year. So what happens in this instance is, when calculating the capital gains tax payable on the 60-day return, you should ignore both of the following. Number one, disposals which have a late completion date, completely ignore it. Number two, disposals on other types of assets on which gains accrue. What this therefore means is that you can account for losses which arose prior to the completion date of the current disposal that we're discussing, but relief for later losses should usually be dealt with via self-assessment. So effectively, we have the situation whereby you have a loss that occurred prior to the disposal. So let's just say this disposal that we're discussing occurred on 31st October 2024, and we had a loss on 30th April 2024. We can utilize this loss when calculating the capital gains tax on the disposal on the 31st of October 2024. I'm going to finish off with two more items. One is a case study, and number two is paying capital gains tax by installments. So I wanted to discuss the loss. We discussed the loss, and we said, if you have a loss following disposal, what do we do? So we have Omar, let's say. My name is Omar, so we'll use my name for today. Omar completes a property sale on, let's say, 28th of March 2024, and I calculated a capital gain after the annual exempt amount of £5,000. My taxable income is £55,000. It's towards the end of the tax year, I'm sort of certain. So therefore CGT is payable at the higher rate. 5,000 would be at 28%. However, a few days later, let's say on the 4th of April 2024, I sell some shares and I make a loss of £2,000. So we made a gain on the property of 5,000, but we make a loss on shares £2,000. I file my self-assessment tax return for that tax year, 23-24, a few weeks later, so in April 2024. And I show capital gains tax is payable on the net amount of 3,000. So what I did, I said I had the gain of 5,000, I had the loss of 2,000, so 3,000, and I put all of it at 24%, which is £720. But at this moment in time, I have not filed a 60-day return because I thought I didn't have to. Okay, why did I think I didn't have to? Well, there's many reasons for that. We don't need to go into all of them. But broadly speaking, what needs to happen is that I need to pay CGT on the full £5,000, and I need to pay it within 60 days, and I need to report it on the 60-day return as well. So I must, within 60 days, technically I should file a report, the 60-day report, by 27th of May 2024. Why? Because we said the property sale was on 28th of March, so 2 months. Therefore, I would, broadly speaking, I would need to file the report by 27th of May 2024. However, and this is the reason for the case study, HMRC say in their manual that in this situation, the capital gains tax payable within 60 days can take into account the loss which has already been reported via self-assessment, even though it arises after completion. So therefore, the £720 that I calculated can be paid by 27th of May 2024, and then you amend your self-assessment tax return and show that £720 has been paid via the 60-day return. So that's the 23-24 tax return. Other reasons where you would, where you wouldn't need to file the 60-day return, broadly speaking, is, if it's fully covered by a relief. Usually we see principal private residence relief. To end this episode, it is possible in certain limited circumstances where you can pay a capital gains tax bill in yearly installments. So, and this can be for UK residential property for UK residents or UK land and property for non-UK residents. And this is usually when an asset is gifted. So, you're gifting the asset. Technically, you're not receiving any cash. It's a gift, right? And this is where you can pay in installments, but it's only available on the following assets, which are land and property, a controlling holding of shares in a company, and any holding of shares in an unlisted company. For example, if you have a property and you gift it to a family member other than your civil spouse, civil partner or spouse, of course. Why? Because that's nil gain, nil loss. Obviously, or sorry, I shouldn't say obviously, but broadly speaking, a gift to a connected party, which most likely would be the case, would be proceeds at market value. So deemed proceeds, deemed market value proceeds, but really and truly, you're not receiving any cash, right? So therefore, HMRC allow that an election to be made. So there must be an election, and this election must be made in writing before the CGT becomes payable. So you need to keep in mind all these, little moving parts in this particular circumstance. And that's why I can make a whole episode just on this topic, because there's so many different scenarios, so many different moving parts can be discussed. But broadly speaking, the point of that was that you can make payments in installments. So capital gains tax can be paid in installments. There is also the time to pay arrangements, and again, you need to discuss this with HMRC. I hope you found that beneficial. I hope you found that useful. If you're watching on YouTube, don't forget to like, comment, share, and subscribe to our channel. And if you're watching on Spotify or any of the other platforms, then do share this episode with those who may find it beneficial, those who may find it useful. My name is Omar, Chartered Tax Advisor. This is a very common scenario, as in, the 60-day reporting, assisting clients with the 60-day reporting, the filing, and the rest of it. Advice, they are proactive strategies that can be implemented to, potentially not pay any tax at all in the first instance. So this requires a discussion with us, and we shall see you in the next episode. I hope you enjoyed it. I hope you learned something. I hope you found some value within this episode, and we shall catch up very soon. Take care. Bye.